So you want to get smarter about investing, right? Really wrap your head around what builds wealth long term,
Hmm.
but without, feeling totally lost or overwhelmed.
Yeah, definitely.
Think of this as kind of an express lane. We're going straight to the core ideas, the ones that really last.
That's exactly what we're diving into today. We're looking at the bedrock principles for a steady path to wealth through investing, and we're using a real classic as our guide.
And let's just ditch those ideas that you need, like a stratospheric IQ or some secret Wall Street code, or just pure luck to succeed.
Right.
Our source today, it pretty much throws all that out the window.
It really does.
Yeah.
Fundamentally, this book boils it down to two absolute essentials for successful investing. First, a really clear, rational way to make decisions.
Okay.
And second, an emotionally stable mindset. Not getting thrown around by every little market ripple.
And the book we're digging into is Benjamin Graham's The Intelligent Investor, or Root originally. This isn't just some random finance book.
No, not at all.
It's basically the Bible of value investing. It's all about rational analysis over gut feelings or hype.
And what's truly amazing is how relevant it still is. I mean, it's over 70 years old.
Wow.
But it's still considered like an essential reading for some of the biggest names in investing, a real touchstone.
And you can't talk about The Intelligent Investor without mentioning Graham's most famous student, right? Warren Buffett.
Absolutely. Buffett famously called it the best book about investing ever written.
High praise.
And, well, his track record kind of speaks for itself, doesn't it? He clearly learned a thing or two from Graham.
So our mission today, it's pretty clear.
Oh.
Let's figure out how a truly intelligent investor, in Graham's view, actually thinks, how they judge things, and how they act in the market.
Let's get into it.
Definitely. So first up, the defensive investor. Now, this doesn't mean someone who's scared of the market, does it?
No, not at all. It's a specific strategy. Graham defines the defensive investor as someone whose main goals are, first, keeping their capital safe.
Okay, preservation first.
Exactly. And second, achieving steady, reliable growth over the long haul. They're not chasing those quick, potentially risky wins. It's really suited for people who maybe don't have tons of time or, frankly, the desire to be super active managing their money day to day.
Right. So Graham splits investors into two camps. Defensive, he calls them passive too, and enterprising, the active ones.
That's right.
And it sounds like he thinks most people should start in one particular camp.
Yeah, he strongly suggests that most folks should begin with the defensive approach. It's generally lower risk and just fundamentally simpler, a solid foundation.
Okay, so if you're going the defensive route, what are the core strategies? What's step one?
Step one is sound asset allocation. He talks about this kind of golden ratio of stocks and bonds.
Ah, the classic mix. What's the thinking behind that?
It's all about balance. So if you hold a mix, maybe something like 50% stocks, 50% bonds.
The 50-50 split.
Right.
Yeah.
The idea, you get the growth potential from stocks, but you also get the relative stability from bonds, especially when markets get choppy. It smooths the ride.
Makes sense. Growth engine plus a shock absorber. Is that 50-50 set in stone, though?
Oh, definitely not.
Yeah.
Graham was practical. He knew this ratio needs to be flexible. You adjust it based on, your age, your income situation, what the market's doing.
So if stocks look super expensive,
You might lean more towards bonds, maybe 40-60 stocks to bonds, or even more conservative. And if stocks look cheap, maybe the other way.
okay.
And crucially, he talks about rebalancing.
Yeah.
So maybe once or twice a year, you adjust back to your target. Keeps your risk level consistent over the long term.
Right. Rebalancing. Keeps things aligned. Okay, what's the next big strategy for the defensive investor? I think you mentioned dollar cost averaging.
Yes, dollar cost averaging. It's a term people hear a lot, but Graham really highlights why it's so effective for defensive investors.
How does it work, essentially?
The beauty of it is how it kind of turns market ups and downs to your advantage. You just invest a fixed amount of money, say $100 or $500, whatever fits your budget at regular times, like every month or every paycheck.
Okay, same amount, same schedule, no matter what the market's doing.
Exactly. So when prices are high, that fixed amount buys you fewer shares.
Mm-hmm.
But when prices drop, your money buys more shares.
Ah, so you automatically buy more when things are cheap?
Precisely. Over time, this averages out your purchase price. It lowers the risk of putting a big chunk of money in right at the market pop, which, let's face it, is easy to do emotionally.
Yeah, avoids that buy high panic.
And maybe even more importantly, it forces discipline. It takes the emotion out of it. You just stick to the plan month in, month out, ignoring the market noise. That discipline is huge for long-term profits. Consistency really is key.
Discipline over emotion. Seems like a recurring theme here.
Absolutely central to Graham's philosophy.
Okay, now Graham also lays out these 8 specific rules for picking stocks if you're a defensive investor going that route, instead of just bonds or funds.
Yeah,
They seem quite detailed. Why so specific?
yeah, they might seem a bit uh, boring, as Graham himself kind of admitted, but that's the point. They're designed specifically for safety and reliability. Think of them as guardrails. They help protect you from making impulsive decisions based on, fear or greed or some hot tip. They keep you grounded in fundamentals.
So they're basically a checklist to avoid dumb mistakes.
Pretty much. They steer you towards established, financially solid, profitable companies that are selling at a reasonable price. Plus diversification. It's about value, not hype.
All right, let's quickly run through them. First, diversification. He says 10 to 30 companies. Why that range?
It's trying to hit a balance. Enough companies so that if one or two do badly, it doesn't sink your whole portfolio.
Right.
But not so many that you can't possibly keep track of what you own. Spreading risk without getting overwhelmed.
Got it. Makes sense. Next, only large companies. Minimum revenue, he said $100 million back then, which is like over $700 million today. Why big companies?
Stability, mostly. Larger, more established businesses usually have stronger finances, more diverse operations, and are generally better equipped to handle economic slumps compared to smaller, maybe more fragile companies.
Okay. Then conservative financial strength. A current ratio over 200%. Can you break that down? What's the current ratio? Tell us.
Sure, the current ratio is just current assets like cash.
Yeah.
Stuff easily turned into cash divided by current liabilities, which are debts due soon.
Okay.
So a ratio over 200% or 2 means the company has at least twice the easily accessible assets as it has short-term debts. It suggests they're very unlikely to run into trouble paying their immediate bills. It's a strong short-term safety cushion.
Like having $2 in your checking account for every $1 bill due next month.
Exactly. A good safety net.
All right. Next rule, a consistent dividend history. Stable payments for 20-plus years straight. What does that signal?
It suggests a mature, stable company that generates reliable profits and is committed to returning some of that profit to its owners, the shareholders. It implies financial discipline and shareholder focus over a long period.
Okay. Rule 5. No losses in the last decade. Wow, 10 years without a single losing year. That sounds tough.
It is stringent, but it really underlines the defensive investor's focus on avoiding big risks. Consistent profitability through thick and thin shows resilience.
Then there's earnings growth. At least 33% total growth over the last 10 years. So steady, not spectacular.
Exactly. That works out to about 2.9% average annual growth. It's about a consistent upward trend in profits, not necessarily explosive, maybe unsustainable growth, just steady progress.
Got it. 2 more. Reasonable asset price. Stock price no more than 1.5 times book value. What's book value again, and why this limit?
Book value is basically the company's net worth. On paper, its assets minus its liabilities. So this rule aims to stop you from paying way too much for the company's tangible stuff, its net assets. It anchors the price to something concrete,
Yeah.
a value check.
Prevents overpaying for the physical stuff. And the last one, reasonable earnings price. Price to earnings ratio, the PE, no higher than 15 based on the last year's earnings.
Right. The PE compares the stock price to how much profit the company makes per share. A PE of 15 or less, based on past earnings, suggests you're not paying an excessive price relative to the profits the company is already generating. Again, it builds in a margin of safety against paying too much for hoped-for future growth.
So paying $15 or less for every $1 of current profit?
Essentially, yes. A lower PE often signals better value.
Okay, those 8 rules definitely paint a picture of stable, value-focused investing. But, wow, that still sounds like a fair bit of work for someone who calls himself defensive.
He can be, and Graham recognized that, which leads to his 4th strategy for the defensive investor.
Ah, the one you called the lazy person's blessing.
Exactly. Index funds. This is incredibly relevant today. Graham was way ahead of his time on this. He recommended low-cost funds that simply track a broad market index, like the S&P 500.
So instead of picking those 10 to 30 stocks yourself,
You just buy the whole market, or a big chunk of it, in one go. You get instant, broad diversification. Hundreds of companies.
minimal effort, maximum diversification.
Precisely. It spreads your risk widely, and you basically guarantee you'll get the market's average return over time, minus very low fees. And like we mentioned, Buffett is a huge fan of this for most people.
Right. His advice was basically, if you're not going to do the homework on individual stocks, just put it all in a low-cost S&P 500 fund and keep doing it.
Yeah, it's simple, effective, and proven for long-term wealth building for the vast majority of investors.
So, summing up the defensive approach, it's about being rational, disciplined, thinking long term, diversifying, focusing on value and safety, and maybe using index funds for simplicity. Stay steady when everyone else is getting greedy or scared.
That's a perfect summary. It's a methodical, lower-stress path to building wealth.
Okay, so that covers the defensive side. But what about the other type Graham mentioned? The ones who do want to put in the extra effort, aiming for better than average results. The enterprising investor.
Right, the enterprising investor. This is the person who's actively trying to beat the market to achieve those higher returns. It
Yeah.
sounds appealing, obviously.
Who wouldn't want higher returns?
Exactly. But Graham is very clear. It's much harder than it looks.
Hmm.
And simply wanting it, or even just spending more time looking at stocks, doesn't automatically mean you'll do better than the defensive investor using those simpler strategies.
So it's not just about effort, there's more to it.
Oh, much more.
Yeah.
Graham lays out 3 really demanding requirements for successful enterprising investing. First, you need extreme patience.
Nations. Okay.
Second, a real genuine passion for constantly learning about businesses, industries, accounting, market history. It's ongoing.
Lifelong learning, basically.
And third, a very significant commitment of time and, again, that unwavering discipline.
So it's a serious undertaking, not a hobby.
Absolutely, not just a hobby if
Yeah.
you want to succeed consistently. And it's more than just knowledge, too. It's a huge psychological test.
How so?
You need the mental strength to completely ignore the market's noise, the daily chatter, the analyst upgrades and downgrades, the headlines. You have to resist emotional reactions, stay calm when prices swing wildly, even when everyone around you is either panicking or euphoric.
Sounds tough.
It is. Honestly, Graham suggests many people, even professionals, find out they aren't really suited for it temperamentally, even if they have the knowledge.
He also warns specifically about overvaluation, right? Market bubbles. He used the dot-com bubble as an example. What's the key lesson there for the enterprising type?
Oh, the dot-com bubble is a classic cautionary tale.
Yeah.
The crucial lesson is the absolute importance of valuation. Back then, you had companies with exciting stories, maybe, but their stock prices shot up to levels completely disconnected from any realistic assessment of their actual business value or earnings.
Pure hype driving prices.
Pure hype. Graham even quotes some very confident chief strategists from big funds back then who were dismissing traditional valuation metrics, talking about a new era. We know how that ended.
Badly.
Very badly for many. His core point is, the fundamental risk in investing always comes down to the gap between the price you pay and the actual underlying value of the business. When that gap gets huge on the high side, danger looms.
So the enterprising investor needs to avoid those dream stocks priced for perfection
Exactly. Steer clear of the hype.
and instead hunt for what Graham called undervalued value. How do you find that? What are you looking for?
For the enterprising investor, price is everything. Forget the exciting story if the price is wrong. They need to actively search for companies the market has overlooked, misunderstood, or unfairly punished.
Okay.
And Graham highlights one particularly interesting, though rare, type of opportunity. Finding companies where the total market value of the stock, the market capitalization, is actually less than its net working capital.
Okay. Remind us, net working capital is.
It's pretty simple. Current assets, things like cash, receivables, inventory minus total liabilities. So all the company's debts.
Right. So if the whole company's stock market value is less than that,
Right.
it's like you're buying the easily sellable stuff for less than it's worth and getting the factories and brand name for free.
That's the idea. You're essentially getting the liquid assets at a discount, and the long-term assets, buildings, equipment, patents, brand, are thrown in for nothing. Graham saw this as a fantastic situation, offering a huge margin of safety.
Sounds amazing. Are those common?
Unfortunately, no. They're quite rare, especially in normal market conditions. You tend to find them more often during really deep bear markets or times of crisis when fear is rampant and everything gets oversold. But they exemplify the kind of value the enterprising investor should be looking for.
So the enterprising strategy is more flexible, potentially higher return, but definitely riskier if you don't know what you're doing.
Yes, exactly. Graham allows more flexibility here. Enterprising investors can look at smaller companies, mid-caps, even companies going through turnaround stuff the defensive rules might exclude.
Looser criteria.
Looser criteria on things like size or maybe even short-term earnings, as long as the focus remains squarely on finding undervaluation. Diversification is still important, but there's no strict 10 to 30 rule. You might hold fewer stocks if you have high conviction based on deep analysis.
but that analysis is key, right?
Absolutely critical. The non-negotiable skill for an enterprising investor is the ability to read, understand, and critically analyze financial statements deeply.
Because you're not relying on an index fund's diversification. You're building your own diversified portfolio based on your specific company research.
Precisely. Your risk control comes from your analytical skill in picking individual stocks you understand well and believe are genuinely undervalued. It requires financial literacy, understanding industries, competitive dynamics. It's real work.
So, wrapping up the enterprising investor, it really comes down to asking yourself some hard questions, doesn't it?
It does.
Like, are you really willing to put in that significant time and effort continuously? Do you have the stomach for potentially bigger swings in your portfolio value?
Yeah.
Do you have the self-control to stick to your analysis when the crowd is running the other way? Can you think independently?
Those are the gut check questions. And Graham's message is clear. If the answer to any of those is no, or even maybe not,
Yeah.
that's perfectly okay. The defensive strategy is still a sound, proven path to building wealth and achieving financial freedom. No shame in sticking to what suits you.
That's a good point. Okay, so we've covered the two main investor types, but there's one concept Graham hammers home as vital for both.
Yes, absolutely essential.
The margin of safety.
The margin of safety. It's arguably the single most important concept in the entire book. It applies universally, whether you're defensive or enterprising. It's the cornerstone.
So what exactly is it? Why is it so crucial?
Think of it simply as your buffer, your cushion, your room for error in investing.
A safety net.
Exactly. It's built on the fundamental truth that the future is uncertain. You cannot predict everything perfectly. Your analysis will sometimes be wrong. Market conditions will change unexpectedly.
So you need to plan for being wrong, essentially.
Precisely.
Yeah.
You need to build in protection against your own fallibility and the market's randomness. Graham uses a great analogy.
The Viking ship one.
Yeah. Imagine building a ship designed to hold exactly 30 people. If person number 31 steps on, it sinks. That's madness, right?
Totally. You'd build it stronger than that.
Of course. You build in a margin for error. Investing without a margin of safety is like building that doomed ship. If you estimate a stock is worth $31 and you buy it at $30.
You have almost no room if your estimate is slightly off or if something bad happens.
Exactly. A small error or a minor market dip and you're underwater immediately.
So how do we apply this margin of safety in practice? What's the rule of thumb?
Graham provides a classic guideline. Only buy a stock when its current market price is significantly below your conservative estimate of its intrinsic value. His benchmark was generally to pay no more than 2/3, about 67% of that estimated value.
Okay, so if your careful analysis suggests a company is truly worth $90 per share.
You shouldn't pay more than $60 for it, preferably less if you can get it. That $30 difference or more is your margin of safety.
That's a significant discount. How do you estimate that intrinsic value, though? That seems tricky.
It is the trickiest part and involves judgment. But Graham offered a simplified formula to get a rough idea, especially for more stable companies.
Okay, let's hear the formula.
The formula is value, current normal earnings, X, 8.5 plus 2, expected annual growth rate.
Okay. Value equals current earnings times 8.5 plus double the expected growth rate. What's that growth rate supposed to be?
That's your estimate of the average annual earnings growth you expect the company to achieve over the next, say, 7 to 10 years.
So it involves forecasting the future.
Yeah.
Which we just said is uncertain.
Exactly. Which is precisely why you need the margin of safety when you apply the formula's output. The formula gives you an estimate, but you buy well below that estimate because you know your growth forecast might be wrong.
Got it. The formula is a starting point, not the final word. You mentioned an example with Amazon and Apple from a few years back. How did that illustrate the margin of safety concept?
Right, back in September 2018. Using their stock prices then and that formula, you could sort of work backward to figure out what kind of future annual earnings growth rate the market price implied.
Okay, what did it imply?
The results were pretty eye-opening. For Amazon, the price implied investors were expecting average annual earnings growth of around 74% per year for the next 7-10 years.
74% annually for a decade. Wow.
Whereas for Apple, at that same time, the implied growth rate needed to justify its price was a much more modest 5.8% per year.
That sounds a lot more achievable.
Exactly. The point wasn't necessarily to say Amazon was doomed, but to highlight how, at that price, Amazon stock seemed to have virtually no margin of safety built in. Investors were paying a price that demanded near-perfect, incredibly high future growth.
So if that growth didn't materialize,
The stock price was very vulnerable. Apple, on the other hand, seemed priced for more realistic expectations, offering a potential margin of safety if things went reasonably well. It forces you to ask, is the growth rate baked into the price actually plausible?
So margin of safety isn't about doubting your skills, it's about humility, acknowledging limits.
Perfectly put. It's fundamental humility about your ability to predict the future. Graham believed this humility is what separates long-term winners from short-term speculators or gamblers.
That ties nicely into another big idea from Graham, one that kind of pushes back against common investment sayings, the relationship between risk and return.
Yes, this is a really important one. We often hear that mantra, higher risk equals higher return.
Right. If you want bigger potential gains, you have to accept bigger potential losses or more volatility.
That's the conventional wisdom, often rooted in academic finance theory, where risk is usually defined as volatility, how much the price bounces around. The theory suggests you need to be compensated with higher expected returns for taking on that bounciness.
Makes intuitive sense, maybe?
It does on the surface. But Graham saw it very differently. He fundamentally disagreed that you automatically get higher returns just by taking on more volatility or more stated risk.
So what was his view? How do risk and return relate in Graham's world?
Graham argued that your investment return doesn't depend on how much risk you blindly take on. It depends on how much intelligence and effort you put into your investment process, specifically in finding assets that are priced below their true value.
Ah, so it's about smart work, not just rolling the dice harder.
Exactly. He made a sharp distinction between intelligent investing, which involves managing and controlling risk through analysis, and just gambling, which is taking risks without a sound basis.
So for Graham, risk isn't just volatility.
No. For him, the real risk was paying too much for an asset or investing without understanding the underlying business. That's where the potential for permanent loss comes from, not just temporary price swings.
How does this apply to the defensive versus enterprising investors?
Well, he argued that defensive investors, by sticking to their rules and focusing on safety, could expect reasonable average market returns with relatively low actual risk of significant loss. Enterprising investors, however, through their skill, patience, and discipline in finding undervalued securities, could potentially achieve higher returns while actually taking less fundamental risk than someone just buying popular expensive stocks.
So higher returns with potentially lower risk if you do the work right. That flips the common saying on its head.
Completely. He illustrates this with that rather grim Russian roulette example.
Right. More bullets, higher payout.
Yeah. He asks, would you play? Increasing the risk, more bullets for a higher potential reward. Of course, no sane person would, because the risk of catastrophic loss is unacceptable regardless of the payout. It shows the absurdity of blindly linking higher risk with higher reward when the potential downside is total loss.
So investing isn't Russian roulette.
Definitely not. He contrasts that gamble with the opportunity of the market to sometimes buy $1 worth of a solid business for, say, 60 cents.
Buying cheap.
Buying cheap. And he asks, is that inherently high risk just because the potential return from 60 cents to $1 is high? No.
And then he takes it further. What if you can buy that $1 for 40 cents?
Exactly. Is buying $1 for 40 cents riskier than buying it for 60 cents just because your potential profit is even bigger?
Logically, no. It
Yeah.
seems less risky because your margin of safety is even wider.
Precisely Graham's point. The lower the price you pay relative to the value, the lower your risk and the higher your potential return. The relationship is inverse when you're buying value.
So risk isn't in the stock itself or even its volatility necessarily.
It's in the price you pay relative to value, and fundamentally, risk, as Graham famously put it, is inherent in not knowing what you're doing.
Wow, that's powerful. It's about competence, not just daring.
Exactly. Successful investors aren't just risk takers. They understand risk, they select their risks carefully based on analysis, they control it through things like margin of safety and diversification, and they use it intelligently. It's calculated risk, not reckless speculation.
That's a huge takeaway. Okay, so as we bring this fantastic deep dive into the intelligent investor to a close, let's boil it down. What are, say, the 5 absolute key takeaways we want listeners to really hold on to?
All right, 5 key things. First, market emotions are your opportunity, not your guide. Remember, the market often swings between irrational optimism and unjustified pessimism.
Mr. Market being moody.
Exactly. See those swings as chances to buy good businesses cheaply when others are fearful, and maybe trim positions when euphoria makes prices crazy. It's like Graham said, capitalize on the market's irrationality.
Okay, takeaway one, use market emotions, don't be used by them. What's number two?
Number two, if you're a defensive investor, focus on diversification across reasonably priced assets, likely a mix of stocks and bonds, maybe using low-cost index funds. If buying individual stocks, stick to those rules. Large, stable, profitable companies bought at sensible valuations. Prioritize safety and steady growth.
Got it. Defensive strategy. Safety, diversification, reasonable prices, long-term. Number three.
Number three, for the enterprising investor, the game is actively hunting for significant undervaluation. That rare gem of finding a company trading below its net working capital is the ideal, though hard to find. It requires serious analytical skill, patience, and discipline to find assets the market has mispriced.
Enterprising. Deep analysis, hunt for bargains, requires real commitment. Okay, number four.
Number four, always demand a margin of safety. This is non-negotiable. Acknowledge that you will make mistakes and the future is uncertain. Buying significantly below your conservative estimate of intrinsic value is your best protection against error and bad luck. Don't build that ship with no buffer.
Margin of safety. Your cushion against being wrong. Crucial.
And the final takeaway, number five.
Number five, higher risk does not automatically mean higher return. True investment logic, Graham style, is about minimizing risk by buying assets for substantially less than they're worth. Buying $1 of value for 60 cents, or even better, 40 cents, is the path to potentially higher returns with lower fundamental risk. Focus on the price you pay relative to the value you receive. Find bargains through analysis. That's where the real risk-reward advantage lies.
Precisely.
Those are fantastic principles, and it really is striking how relevant they feel today, even decades after Graham wrote them. Which kind of leads to a final thought, doesn't it?
It does. A question, maybe, for everyone listening to mull over.
Yeah.
Given everything we've discussed, the timeless logic of value, margin of safety, emotional control, how do you think these core Graham principles apply in today's market? With all the technology, the speed, the new types of companies, are they still the bedrock? Or do they need, I don't know, significant tweaking for 2025 and beyond?
That's a great question to chew on. What do you think? Are Graham's ideas timeless or time-bound? We'd genuinely love to hear your perspective on this. Drop your thoughts in the comment section wherever you're listening. Let's keep this conversation going and learn from each other.
Yeah, let's build that community of intelligent investors together.